Hey, this is Bitcoin Asset Research with Allard. Today I'm going to talk about Bitcoin miners buying Bitcoin. This is definitely getting harder to ignore. They keep issuing these convertible notes and then using the proceeds to acquire Bitcoin. Here we have Hut 8 announcing the new ATM and saying the proceeds will go towards buying Bitcoin. Here we have Riot announcing a convertible senior notes offering, and like many of the other ones done by Mara and MicroStrategy, this has also been upsized. And they are primarily using the proceeds to acquire additional Bitcoin. So BTC Yield is really catching on. For those who don't know yet, BTC Yield was this KPI pioneered by MicroStrategy to describe an increase in Bitcoin per share over some period of time. And they always use the most conservative estimate of the share price because of all of these ATM and convertible notes activities. They use the most conservative estimate of diluted shares, so assuming everybody converted on the spot. When this KPI first came out, I wrote an article on Seeking Alpha talking about how this is really a really big moment in corporate finance and a very big moment for MicroStrategy. The stock is up 247% since I recommended a buy rating. And sure enough, in the preceding months, you have other stocks like Semler Scientific also starting to use the BTC Yield KPI, and you have Mara quoting the BTC Yield KPI as well. So what's even more interesting than BTC Yield, or rather what's the most interesting thing within the BTC Yield topic, is that miners are now starting to join the game. Mara has been leading the charge on this, and other miners, as you've just seen, are starting to follow. This would be something to observe as an investor. So let's just quickly do a recap on the capital raise by Bitcoin strategy. MicroStrategy was really the first entity to do this. The procedure looks like this. You convert your cash treasury to Bitcoin, and then you issue shares and you buy Bitcoin, and then you borrow money to buy Bitcoin. And this injection of Bitcoin, which is a 70 vol asset, that increases the volatility of the stock until you can finally do the most bullish move of all, and that is to sell your volatility to buy Bitcoin by issuing convertible bonds. Convertible bonds are obviously normal bonds embedded with a call option, so that call option gives the convertible bond investor exposure to the volatility of the stock. So really what you're doing is you're selling the volatility of your stock in order to get money, and then you're taking that money to buy Bitcoin, which increases the volatility of your stock. So you can see how you can repeat this process over and over again in order to get a huge amount of Bitcoin and increase Bitcoin per share rapidly. And this is how MicroStrategy is able to print very impressive year-to-date BTC Yield numbers. So the more Bitcoin, the more volatility you get, the higher the option value, and the lower the interest rate on that convertible debt. So the goal is to grow Bitcoin per share by tapping the capital markets. And this looks like your equities. This would be your at-the-market offerings. Capital markets, of course, include debt or bonds. And convertible debt largely falls into this category. These are our convertible bonds. And of course, you have the derivatives markets, which also convertible bonds are involved with because of that embedded call option. So as long as the costs of capital in these markets are below the expected long-run CAGR of Bitcoin, then all of this makes sense. It makes sense to issue equity, it makes sense to issue debt, it makes sense to do convertible debt offerings and pile all of that money into Bitcoin, because if the costs of capital over here in these three categories are lower than Bitcoin, then it makes sense to sell this in order to buy Bitcoin and pocket that spread for the shareholders. So MicroStrategy has executed this strategy to an incredible effect. And this is really what that performance looks like. After 4 years of doing this, MicroStrategy has absolutely demolished all of the competition in the S&P 500. MicroStrategy's convertible bonds also are outperformers. If it outperformed Bitcoin, then certainly you can be sure that it has outperformed most of the S&P 500. Now, if you're learning something so far, I just ask you to like this video, subscribe to the channel, share it with a friend, ask a question, leave some kind of comment or suggestion. Help me expand the reach of this video and help me make these videos better with your feedback. Now let's get back to talking about Bitcoin miners, because this was originally what the topic was. Their business model is inherently leveraged to Bitcoin. As a miner, your operation is much like a Bitcoin call option, where the strike is the cost to mine. So let's say you can mine a single Bitcoin for $30,000 worth of electricity costs. That kind of looks like a Bitcoin call option where the strike price is about $30,000 per Bitcoin. So in that case, like this entire operation, a mining operation, resembles a call option, which of course is a leveraged position on Bitcoin. And miners already trade with a very high beta to BTC. So if Bitcoin moves like 1% a day, then a miner might be expected to move 2 or 3% a day, right? So there is this multiplicative effect, and in finance this is called a beta to the asset. They also have a very leveraged capital structure. Most miners have debt on the balance sheet, so whatever Bitcoin they have is really like leveraged Bitcoin, because theoretically they could sell the Bitcoin to cancel out that debt. But if they don't do that, then that is a leveraged capital structure. So given these facts, miners have the volatility for a convertible bonds strategy to work. Bitcoin, of course, is a 70 vol asset. MicroStrategy is over 110 vol. Miners also have very high vol, like many of them are well over 100. So when you're looking at it from that perspective, these are the equities that can do this convertible bond strategy because their volatility is high enough, just natively, because of their business operation being so inherently exposed to Bitcoin already. So if a miner can take out debt at near 0% rates and then use their mining operations to service the debt, then it makes total sense for them to be using the convertible bond proceeds to buy Bitcoin. The alternative is really quite bad, because it looks like just buying a lot of depreciating ASICs and then having a lot of lead time towards setting them up, working through the issues, and you would only mine a small amount of Bitcoin over the next few years. You would spend a bunch of capex upfront, and then your return on investment trickles in over the next few years, and it might take some time for you to break even, versus just buying Bitcoin with borrowed money right now and then paying back 0% interest. Obviously the debt option looks a lot better. So once you've internalized that Bitcoin can be treated as this hurdle rate, then it becomes very hard to do something besides buy Bitcoin, since most things are not going to outperform Bitcoin. And this is actually a feature of being on the Bitcoin standard, not a bug. I repeat, this is a feature, not a bug. Now, of course, all of the experts are going to start screaming that this means literally nothing will ever be done, because their reasoning is, oh, if I can just buy Bitcoin, why would I do anything? Why not just buy Bitcoin with everything and not create anything? And the answer is, of course, that they are totally strawmanning this argument out of either ignorance or malicious intent to deceive. What the Bitcoin standard actually means is that only the most efficient and profitable things will get done. Everything below the hurdle rate, everything below the rate of return for Bitcoin, it's by definition not useful enough to be done, because, of course, it would be better to just get Bitcoin instead. So in the long run, if everyone started doing this, what actually happens is the only things that get done are the extremely efficient and profitable things. So resources across society are not as wasted as they are under a fiat standard. When miners broadly adopt this paradigm of leveraging their volatility to buy Bitcoin at 0% rates, we might actually see some outperformance in miners. So when you look at the historical performance, Bitcoin outperforms miners. Here's a broad basket of miners, and here's Bitcoin, and you can see only Mara has outperformed on the 5-year chart. Now, if we look at the 3-year chart, it becomes much more damning, because Bitcoin has literally outperformed all of them. So if a miner is working on mining Bitcoin and that itself cannot even outperform Bitcoin, then why bother with investing in miners, right? That's really the logic. That's really the question that you have to start asking yourself if you're investing in this space. And when we look at the 1-year chart, you can see again, only one miner has really outperformed Bitcoin. And by the way, TeraWulf is also the one miner here that has made a very successful transition to HPC. So the next steps to watch out for would be which miners are selling their ASICs so that they can achieve a higher average fleet efficiency, and which ones are repurposing their sites and diversifying into more profitable use cases for their energy assets. So this would look like AI computing, HPC. And on that tangent, we have miners developing revenue streams that are adjacent to mining. So Mara has stuff like Mara firmware and their two-phase immersion cooling technology, and all of these things, they're adjacent to Bitcoin mining. Then they can still earn these cash flows from doing mining related things, but not directly mining the Bitcoin. And what we would want is for these companies who have these successful diversified revenue streams to put all those proceeds into Bitcoin or into interest expenses on the convertible debt that was used to buy more Bitcoin. Mining is a really tough business. It's a perfectly competitive market. Plus, you also have to contend with all the price insensitive miners, right? Like you have the heat bits, you have the bid axis. This is all technically competition that doesn't really care about their cost of power. So they'll be mining no matter what. And when you think about it like that, it just becomes clear how perfectly competitive this whole thing actually is. And perfect competition, of course, leads to very low/0 profits for the companies that are involved. So you want to get out of this tough business with no moat. You want to get a moat as fast as possible and then buy Bitcoin, grow Bitcoin per share, generate a Bitcoin yield, hold more Bitcoin on the balance sheet. Any alternative is just not going to make it. If you enjoyed this video, leave a like, subscribe to the channel, let me know your questions or comments in the comment section. Give me suggestions for future videos. Thank you so much for watching. I'll see you in the next video. Bye.